Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the governor himself. He used to be the mayor. Now he's the governor because he's moved down to Austin to buy a property down in Austin. How many doors is that one, Michael?
Which one? So we have a 160 and a 460 unit down in Austin.
Holy cow. So the governor of apartment lending and apartment ownership, Mr. Michael Becker is joining us. Thanks for joining us. We are here in San Jose, California. We're joining with JC Castillo and his Apartment Investor Network up here at the DoubleTree Hotel up in San Jose, California. So tonight we're going to talk a little bit about what's going on in the later innings. Can we do profitable transactions? So JC has assembled a good-looking audience of about 40 or 50 people that have joined us. And so it's going to be some questions. We're going to get hopefully some answers from Michael Becker and myself, and also with JC. So let's kick it off a little bit. So we appreciate you guys listening in. You're part of the audience. So Michael, tell us a little bit about what we're going to talk about today.
Just doing profitable deals in the late stage market. So it's no secret that the valuations in multifamily have certainly accelerated over the last 7 or 8 years. So is it still possible to do stuff, and what are we thinking about when we're out there putting these transactions together? So JC has a handful of questions, so we'll kick it to you.
Yeah, let's kick it off, guys. So first things first, should I be a buyer in this market, Michael?
So should I be a buyer in this market?
Yeah, I believe so. You know, it's all market dependent. It's all sub-market dependent. I think that there's a lot of good markets across the country. I think I happen to live in one, which is in Dallas, and we have offices in both Dallas and Austin. So I really like all the major Texas markets. I like Phoenix. I like Atlanta. Has a lot of economic drivers. I think that makes sense. So, you know, really what we focus on are areas that have friendly business environments, favorable landlord-tenant laws, that are in, you know, economically expanding areas. We have population growth, we have population immigration, we have positive job growth as well. So those are some areas that I think make sense. I don't think it makes as much sense if you're in a area that potentially is declining. You know, I like Dallas a lot more than Detroit, for example, for that reason. I mean, you know, I like Texas better than California from the standpoint that if you don't pay your rent in Texas, we will put your stuff on the curb. And if you don't pay your rent in California, you get to live for free. So those are some key distinctions when you're putting a lot of money out. So there's always a deal out there in every market. So really the question, JC, I think is how do you do deals in up markets, and how do you structure them to both make profit and mitigate the risk in the deal?
All right, so question number 2 is, okay, so Michael's telling us that there are deals out there to be done at the peak of a market. So where can folks out here find profitable deals these days? I
wouldn't say we're necessarily on the peak. I don't know. I mean, you don't know until you have the benefit of hindsight. We could have another couple of years. You know, I think the record expansion for the longest record expansion is something like 120 months. I think we're 105 or 106 months of an expansion. So we're not even at the record, and it wasn't the record when it was set. So I don't really know when it's going to end, and nor does anyone else, but still feels pretty good. So the question was, where can I find profitable deals? You know, I think most of them are made. What we try to focus on, a lot of people that Paul loans money to, and I know a lot of what you do, is profitable deals are made. So we're finding opportunities that are underperforming for whatever reason. So most of these deals either have a physical issue or management issue or some combination of the two of them, that you can come in these deals, find some opportunity to, you know, cure any sort of deferred maintenance, or the units that we're buying are classic is what we like to call them. So they have white appliances or gold or brass light and plumbing fixtures, and we get the property down the street. It has black appliances and brushed nickel fixtures, and they're getting $100 more in rent than what my property is. So if I just spend $4,000 or $5,000, make my units look like theirs, we can raise the rent. That's a pretty simple business. Or if they're just unattentive in their management style and we implement a more professional management style, we can come in and get a lot of just kind of organic rent growth just by asking for it, by having better management. So those are some places that I'm looking for. The longer we go in the cycle, where I personally get a little bit worried, A lot of people have been making a lot of money. It's a rising tide. All the boats are floating here, but a lot of people have been buying some questionable locations. So these areas like the Hood, they've been buying in the Hood.
What's Becker's rule number one?
Yeah, don't buy in the Hood is rule number one. And I've been wrong for 6 years in a row. I've been crying wolf that these guys are going to lose all their money for 6 years in a row, and they've only made money, but they're going to make money until they don't. And these higher crime, lower socioeconomic areas, at this point in the cycle, there's not much differentiation in cap rates by property grade and by location. So I think these people are taking undue risk. So I think on a risk-adjusted return basis, a lot of these people are taking this risk. The market's kind of covering up for them. But when it corrects, those areas are going to kind of regress to the mean a little bit more, and there's going to be more economic loss, more physical loss, more these tenants tend to beat their units up a little bit more. So I think those areas are tend to be the most risky. So I'd focus on better located deals, and stuff that you can, through your efforts, through your business model, you can force some value in. Paul, do you have anything to add?
Just talk a little bit about what you think is one-time capital repairs. Like you fix a property up, you put $4,000, $5,000, $6,000 into the property and these older properties. You think it's a one-time event. Is it a multiple event every year?
Yeah, so that's one of my little sayings is a lot of these older buildings, and at my company, SPI, what we've been trying to do is when we first started buying properties, like many people, we bought Class Cs who are buying 60s and 70s vintage multifamily, so that's Class C in Texas. And we've kind of went to the 80s, which is Class B, and now we're buying kind of early pre-recession 2000s vintage stuff. So that's kind of 2000, 2008 vintage is predominantly what we're purchasing today. And what I found on these older buildings, JC, I'm sure can speak to this better than I can, is you have all these one-time non-recurrent expenses. So say like you have a boiler that goes out and it costs you $20,000 to get hot water on your property again. But in these older buildings, you have all these non-recurring expenses that recur all the time. So you have these collapsed sewer pipes that just kind of are more prone to recur on these older deals. And so that doesn't necessarily impact your net operating income. So it doesn't impact like the NOI of the deal, which is how we value commercial real estate as NOI divided by cap rate. But it's a real cash expenditure because I can promise you your plumber wants a check when he does the work. So it's a cash expense. So that either has to come from reserves you set aside up front or from not paying your investors on a monthly or quarterly basis because you need to pay your plumber.
Yeah, that makes a lot of sense. I mean, I like that. Recurring, non-recurring expenses.
Yeah, recurring expenses that recur non-recurring expenses that recur all the time. Yeah.
That's great. Well, you guys were talking about sort of location and making sure you don't buy in the Hood. So bringing us right into our next question, what types of assets, classes, and markets should one be focused on these days?
I just kind of referenced it a little bit ago in the last answer, but what I'm observing in the marketplace, you go back to Dallas-Fort Worth as an example, about 5 years ago in our market, you could buy a brand new Class A property for about a 5 cap. A B property would be 6.5 cap, and a C would be 8 to 8.5. Fast forward 5 years to today, an A deal is like 4.5, a B deal is a 5, and a C deal is a 5.5. So what used to be a pretty healthy spread between the highest grade to the lowest grade, they all are, it's compressed quite a bit. So that shouldn't be the case, but it is. So I think a lot of people are more likely to have a little bit of issue on the lower end of the market. And then the one thing I haven't heard as a term several years is a D-class property. I think people are just kind of forgetting that actually exists and they're calling them Cs. So everything's lumped in. So I don't think people have been searching for yield for so long, they're willing to go down in quality standards. And I don't think they're properly accounting for the risk-adjusted basis of it. A lot of that stuff's the capital expenditures that you likely will have to incur on these older deals. And that's easy to say for someone that's done a bunch of properties and have the ability to buy these larger deals because, that's not a fair business. People aren't going to sell you a $50 million building if you've never done this before. You have to have a track record and work your way up. But within that, I think these are just things you should think about when you're putting your capital at risk that, I need to have my proper reserve set aside to cure this stuff. And I shouldn't take undue risk on location or property quality and, dramatically overpay for these deals. So these are just things that I think about. So that's kind of why I focus. And then the better located deals, it doesn't have to be at Main and Beverly Hills. It could be, nice working class community. Crime is really what I focus on. It's hard to overcome crime. So if you're in a high crime area, that's going to come back and bite you at some point. So those are the things that I think about, Paul.
Yeah, crime is a big thing, at least in lending, and especially violent crimes on properties, as you can imagine. Nobody wants to live in an area that is affected by a large amount of crime with high density. So crime is one of the things that can stop you from getting a loan on a property. So make sure before you go hard with any earnest money that you do a crime stats report on the property, or make sure you have your sponsor do a crime stat report. There's always some oddball deals. There's maybe a double murder on the property out of passion. But if it's an area that has a double murder today and has another violent crime next week, and it had one 3 weeks ago, that's an area that we're going to have some deep concerns on. It comes back to rentability. How many people are going to want to live in that area? Even if you've put $4,000 or $5,000 per door into the property, what's the likelihood of trying to attract a higher quality of caliber of tenant to that property? So you can change tenants, but sometimes you can't change the demographics of the area around the property, because you just don't know where you may spend $300,000, $400,000, $500,000 in your property. The guy next door is not spending anything. So find areas, just like Michael said, don't buy in the hood. And right now, my feeling is that I think we're lacking some quality decisions by buying into the hood, just because they think that you can have a higher rate of return if you do it.
So, I think we want to sort of switch it up a little bit here. And, we talked about the asset classes, and we talked about, location and sort of what sorts of properties that we're looking to potentially purchase in this cycle. But now I want to kind of take a little bit of a turn here and sort of focus on the lending piece, right? So as Paul likes to say, 70% to 80% of the capital on any deal that we do is actually coming from the lender, from Paul. So actually, Paul is actually our best friend in any deal that we're looking to do.
I'm your best friend.
That's right. So seeing that Paul's going to be our best friend here, what is the best financing strategy, Paul, in today's market?
So we have to think about how we can reverse engineer these deals. I mean, when you buy a property, how long are you actually going to own the property? So these properties are owned in dog years. So every 1 year that you own it, it's like 7 years. So it's
That's
not
true. Yeah, it feels that way.
So the reason why I say that is because if you own a property for say 1 or 2 years, like 14 years, you're making a decision whether you want to keep with the property or if you want to sell it. If you keep with the property, you want to go bigger, because typically economies of scale, you've bought a little 45-unit building, now you want to bring it up to maybe a 100-unit building. So you may sell it after a period of 2-3 years, and then you want to go up, or you just, no mas. I don't want to put any more money into this deal. I want to get out. I want to put my money into stocks. I'm done managing apartments and going with that. So going with the end in mind, what type of loan is the best loan? We talk about, I don't know when the end of the world's coming in terms of the financing, whether it's the Bible that says you don't know when he comes in the darkness of night. I have no idea when the economics of the banking cycle will stop. So you always have to think, is that if I get into a short-term, say, bank loan for, say, 2-3 years, is that the right thing to get into? Or do I want to try to mitigate my risk and go as long as I can with the longest term possible with a 30-year amortization so I keep my payments low? Do I want to do something like that? And I would say yes. Right now in this part of the cycle, how to mitigate risk for the downside is get into long-term permanent debt as far as you can on these deals. Now, if you're only going to own the property for, say, 2-3 years, these loans, say it's Fannie Mae or Freddie Mac, they are going to have the ability for somebody to assume the mortgage. And if the NOI goes up after a year, you can take cash out of that property, or the next buyer can go with higher leverage in the transaction. So you can sell the property with a loan that's already in place and let somebody leverage the deal up into the transaction. So instead of, if you sell the deal, you're going to have to pay a significant prepayment penalty. So what you want to do is have somebody assume the loan. So assume the fixed rate. So we're all about mitigating the risk on your balance sheet. Even though it's non-recourse, we don't want to see you lose money, anything greater than that. So make sure you try to do fixed rate, long-term, as far as you can. Again, I do not know when the Crypt Keeper's coming. I've been a Crypt Keeper, which means I've had a sickle in my hand saying, I choose you, I'm going to take that property back. Michael has had that before, so I've gone through many cycles. We don't want you to be a statistic in the cycle, so go as long as we can. Because we know that if you hold on to this property during this depression, it may be a short period of time, that when you come out on the backside, values will be even higher. So go long as you can in the term, and then kind of work your way out on the property. You can always stop paying rates of return to your investors, but you don't want to have the property taken back and have all your investors lose their money. So that's just one of the things.
So I think 2 follow-up comments. The smaller the property, the more apt that analogy of owning in dog years is. So, if it's a 20-unit deal, it's a lot more painful to own and manage and operate than it is a 200-unit deal, simply because of economies of scale, and the larger the deal, the more revenue produces, and the more staff and the better quality staff you can afford. And they make your life a lot easier, trust me, than if you had to kind of manage it remotely. We'll talk about Max and Marco about that earlier. And then if you are willing to take these small deals, I would probably not put a long-term fixed rate loan on it, because you're going to want, like you said, we're going to want to kind of get in and out. But maybe at this point in the cycle, just lower your leverage a little bit. Don't go 70 instead of 75. Put a little bit more down. Take the risk off of it, because then if you have a shorter maturity, the more equity you have on the front end, the more likely you are to be able to refinance it if you happen to have a low maturity in a bad time, say like 2009. Most of the people in the markets that I saw would have been able to survive. A lot of people's got in trouble, say 10 years ago, just had a low maturity at a bad time. So when the capital markets, when there's a recession, they just tend to turn the spigot off, and then it comes back on real slow. But when it goes off, it goes off. It's just like it's overnight. So, making sure you have a little bit of runway, making sure you have a little bit more equity in the deal. I think these things, if you have a good asset that you put capital in on the front end, you're not having all this deferred maintenance while you own it, these things that pop up along the way. If you do your best to mitigate that, if you have professional management in place to kind of help you make sure you don't get into trouble and you're buying in the better located areas, you do that. That's probably 95% of the risk in these deals. I'm not saying something can't happen, but if you do that, you likely can hang on almost in any environment, especially in housing as a universal need. So these things are generally pretty stable for the most part. So those are the things I think about when we're putting these deals together.
Should you underwrite these deals at 95% or 97% occupancy?
That might be your physical, but then there's certainly some economic loss within there. And the lower the property grade, the more likely there's going to be some economic vacancy, which means that people live there but don't pay you rent.
So
which is worse.
Yeah.
It's worse. Easy. That's worse than physical.
Yeah, it's easy to fill these buildings up. The tough part is getting all the people to pay. That's the challenge. So, my feeling on something like this is, just like Michael says, ask for a little bit more equity into the transactions. That will definitely help you, whether we have a spike up of interest rates and now your loan dollars get cut. But also, too, is that a lot of people the last 4 years or 5 years don't know what physical occupancy is or economic occupancy when it goes below 90%. A lot of them think it's always going to be 95 or 97% physical occupancy, which means we have the majority of the property as people paying rent on the units. But if the economy falls apart a little bit, we'll go down to 85, 80% occupancy. Have a plan B on these deals and what you're going to do.
Well, I would say that, Paul, a lot of people in this audience, may be thinking like I am that, look, if you put a glass cookie jar with a bunch of nice tasty cookies up there, I think the people are going to want to take those cookies and take them out of the jar. But so what are the banks doing to make sure that if these little guys can't control their little hands, that the banks are actually reacting to the market by putting their own backstops in place? So how are the banks reacting to the current market?
So these deals are underwritten really strongly these days. If you went back about 7-8 years ago, we used to have subprime single family, but they also had subprime multifamily too. So we would underwrite these deals with interest only, and we would instead of having occupancy that actually was at 85%, we pushed it up to 90%, because when you took it over, you were going to push it up there, and that's what we knew you were going to do. And then instead of having 10 or 12-year terms, we would probably do 2-year terms or 3-year terms with a significant penalty to get out of it. But we knew you were going to execute your game plan and go and have the value of the property go up because you're going to raise the NOI or into the property. So again, we had subprime loans, but probably in the last 5 or 6 years, we underwrite these transactions very hard, which means we stress them out. We want to make sure in the case there is an economic collapse around the corner that we know that you can continue to make your payments in the transaction. So I think in multifamily versus single family, I think we have more critical underwriting in multifamily than they do in single family. If we went through the last recession, I think we had 0.1%, 0.2% delinquency. So that means we were not having a lot of properties go back to the bank. There was a few, but not a lot.
That's with the agencies, with Fannie Mae and Freddie
Fannie
Mac
Mae and Freddie
specifically.
Mac,
So
yeah.
and then what I'm observing is they always have what's called a debt coverage ratio, and it's got to be 125% of NOI or 1.25 debt coverage ratio. And so what that's doing right now, is just constraining. So they're getting debt service constrained, which means that you got to hit a 1.25 debt coverage ratio. Even though you get 80% loan to value, you also have to hit the debt coverage ratio. So the value's there, but the debt servicing isn't. So they're cutting the loan proceeds down until you hit that 125 debt coverage ratio.
So on a $10 million transaction, we have to use that 125. I have to make sure I have enough income to cover your mortgage payment in that deal. And so my maximum in Dallas, as an example, I can go to 80% leverage. So all-in acquisition price times 80%, that's my maximum loan amount to do it. But because of NOI hasn't caught up to price and values of these properties, we're underwriting deals that they're coming out at 70% or 72% because they're debt coverage constrained, which means I don't have enough income. So when I underwrite deals, I don't underwrite these deals looking through the windshield of what the car is. I'm looking at through the rear view mirror. How's the property performed in the last, say, 1 month, 3 months, 6 months, or 12 months? That's what I have to use for Fannie Mae. Okay, so that's an important point. I have to understand the debt coverage ratio and the constraint that it may put on. So that property may be worth $10 million or maybe worth $12 million, but if I can only get a $7 million loan, that's the most I can get based on the amount of financials coming in on the property.
And so I think that's going to be a kind of a governor of any major, whatever the next recession is. I don't think it's going to be a lender-driven event like it was a decade ago.
That's a good point. So, we talked about the properties themselves. We talked about the financing of the properties. But, we have this whole concept of supply-demand in any sort of market that we're in, any sort of, technology, everything, right? It's all about supply-demand. So, Michael, I think I'd like to ask you, because you sort of have a pretty good feel on the market, and especially since you're sort of in more of like the BA space. Are you seeing any impacts from a lot of the new supply that's entering the market right now?
We haven't noticed too much of trickle down the workforce housing, but yeah, this certainly has impacted. So most major markets, Dallas is a good example of that. I think we were number 2 in total unit delivery for many years in a row. So in Texas, we like to do a lot of things, and one of them is build apartments. So they build a lot of apartments in Texas. I know that a few miles away from here in downtown San Francisco, they built a lot of apartments. So what's being delivered, I'm sure it's no surprise to anyone, is just really Class A plus stuff, top of the market, renting, for very expensive units, and a lot of them are in the urban core or very top flight suburbs. That's kind of where the majority of the multifamily units are being delivered across the country. So where they're not being built so much is not quite as much suburban, and it's certainly not workforce housing. We're having a very severe affordable housing crisis in the country, and the only way they can build these units is to project these really high rents because of the cost of labor. Now it's getting even more exacerbated with the tariffs, and so steel and lumber and all these building costs are going up. And if you're in a market like here, you have all the regulatory pressures on top of that adds whatever else to the cost of these deals. So the top of the market, there's been quite a few concessions, and because all these units are really expensive, all concentrated in a very close proximity to each other, so you're seeing a lot of concessions. So I really think I've seen that there. I haven't noticed it as much trickle down into the workforce housing space. So kind of the B to A minus space is what I play in. Most of these units that we have are still 20% or 30% below the average rents of the top of the market. So obviously our product's inferior to what they have from like a quality standpoint, just being that our stuff's 20 years old or 30 years old versus being brand new. But there's a pretty significant gap. So I still feel there's quite a bit that would have to fall before it really trickles and immediately impacts us. But I think JC used an analogy, which I'll steal right now. Earlier today, it's like calm lake and there's a pebble drops in it. So the closer you are to that pebble, the ripple will affect you a little bit more. So the A minus stuff's probably a little more susceptible to new supply. But if that A minus stuff is further away from where the concentration is geographically in that submarket, it'll have a less impact. So, the closer you are to it, the closer you are to the epicenter, the more likely you are to be impacted. But I don't think it's really impacting like the 1970s stuff. If anything, that supply is being removed as they tear it down to build something nicer and newer. Paul?
Yep.
There you go.
So, one of the things in Texas is that how many people have been to Dallas? Thank you.
Good, yeah.
But thanks for your dollars. So if you look at Dallas, we have the central business district area of Dallas, and around that we have a lot of affordable housing units. But if you go farther up north, up to like Frisco or Allen, these are higher rent districts of properties. The worst thing that we see going on right now is we don't have enough staff to work in the restaurants up there. So they got to commute for $15 an hour all the way from North Dallas, Frisco area, all the way to their house. So again, we're not building Class C properties up here. They're down here. I mean, we are building Class C properties right now. I guess we are. We just have to wait 40 years for them to become Class C properties. So, but that's a serious thing for us on the affordability side, is that it's becoming more costly for food, and because labor is so expensive and has to commute every day, similar to what it is here too, I would think.
Yes, I mean, I think that new supply is going to obviously affect, in some ways, it could have a temporary effect on revenues, right? But I think the other thing to look out for is also, let's talk about the expenses. Expenses are the other part of a profitable business. So, maybe I'll let you take a first crack at this, Michael, but do you see any sort of inflationary headwinds in terms of what we're seeing with operating expenses these days in apartments?
Yeah, I think it's pretty much nationwide, but in Texas, it's an acute thing. In the last several years, it's been a big problem. It's just property taxes, where in Texas, you're not capped. You can get reassessed every year, and there's no commercial property. There's no limit to what they can raise it. So, you're going to literally double your expense year over year. And so that's been a continuous headwind for many years. So that's been something we've already been dealing with for a long time. The next thing that's really been kind of challenging is just labor. And, like here, many of the markets are 3 to 4% unemployment. So that means the only people that are unemployed have to be really something wrong with them. If you can't get a job today, there's likely something wrong with you that you can't get a job. So our talent pool that we're pulling for, trying to get from, in particular on the maintenance side, they have a lot of other options. So where we could get a good quality maintenance guy a few years ago for $15 an hour, it's $17 or $18 an hour. So that's kind of, we're having some inflationary pressures and payroll in particular on the maintenance side. And then the next thing that is now starting to become this year a challenge is insurance. I mean, in Texas, we had, in North Texas, we have like wind and hail. So we have big hailstorms that take out your roof, and then you get, a $500,000 new roof or whatever, these large claims. And then the southern part of the state, we had some hurricanes, the one that hit Houston in particular. So it's kind of impacting our state. It's impacting many states, but we're certainly feeling it in Texas. So that's the next thing that's coming from an expense standpoint.
Talk a little bit about expenses caused by hail. Last year, how many roofs did you have to replace?
3. So far this year, none. So 2 the year before, 3 last year.
And a typical hail claim is how much money?
I think last year we had another small fire somewhere, but I think last year we paid in about $1.2 million, $1.3 million in insurance premium. We had about $2.3 in claims. So you can only do that so often before they start jacking your premium up. And that's just not us. That's, the market. It's a pretty common thing because these hailstorms hit large areas. So that's just a challenge that we have in our market. You guys don't necessarily have that here. You have your own pressures and your own issues here, but that's certainly something that where the planes fly over those states, that tends to happen there.
JC, tell us about your hail claim.
Oh, jeez. Yeah, I mean, I've got firsthand experience in Texas. We had a hailstorm in a city called Wiley, which is just a little bit, what I would say, northeast of Dallas. And we had softball-sized hail come through our property. And I drove the property after it happened. It looked like a war zone. There was holes in the roof that were the size of a softball. And in some cases, the softball-sized hail had gone not only through the decking of the roof, okay, so the plywood decking right beneath the shingles, but in some cases it had actually gone through the drywall ceiling. And so you look up to a roof of a second floor unit, and you can see like sunlight coming right from the roof into the property. So that was a huge hailstorm. I mean, and this happened. It hit the entire city of Wiley. It was a complete disaster. In fact, the insurance companies couldn't even keep up with the claims. There were so many claims, we had to get in a long line. But these are something that you sort of get used to doing business in the North Texas market.
Michael, tell us about inflationary pressure when it comes to rehabbing properties.
Yeah, that's the other thing too. We're buying a property and we're going to install some carports, and we're using a number of $1,500 a parking spot or something like that, and that just went up 25% with the steel tariff. So that's that. Appliances, lumber, those are all things that are going up. So just, sometimes, I got myself a couple years ago, I kind of felt like I was getting caught living in the past a little bit, where it used to cost $3,000 or $4,000 to renovate a unit. We'd budget for that, and then we'd kind of get 90% of the way through it, and like we didn't have the money to do the rest of them, and they're like, well, you're only budgeting $1,000 for appliances, and it's now $1,100 or $1,200. So it's just something that we're constantly staying on top of a lot more frequently. So just need to make sure you're paying attention. It's just getting harder because everything's moving quicker. So just trying to make sure we're staying on top of it as quickly as possible, and constantly challenging our own assumptions along the way, because it's always a moving target a little bit. And having contingencies are certainly a good plan as well.
I think that it's a good thing to talk about. I'm a guy here. I've got a little bit of experience in real estate, and I'd really like to know from some guys that have been around the block for a while, what are some risks to watch out for in this stage of the market?
I've touched on several of them. I think people are stretching on quality and location and not properly assigning a risk to it, or not assigning any risk to it. That's certainly something that I think a lot of people are doing. So all properties, all locations are not equal. So you shouldn't expect the same rate of return on a highly leveraged deal in the hood that's 50% occupied as you should a well-occupied building in a nice part of town that's much newer. So the cap rates being, I joke that everything's a 5 cap in Dallas. So like everything, regardless of property grade, location, everything's a 5 cap. So that shouldn't be the case. So there's going to be winners and losers with this environment at some point. Right now, it's like we're defying gravity, so it doesn't matter right now, but one day it will. So that's something I think that people are not really assigning certain risks. So I'd watch out for that. There's been a lot of people that have come in here recently doing deals that might not be properly setting up their capital stack and properly having the proper management. Going back 10, 12 years ago, I remember one of my colleagues literally made a loan to a UPS driver from Los Angeles, and he self-managed apartment complex in Dallas, and that didn't end well at the end of the day because he sold some house and had $500,000 and he 1031 to buy an apartment in Dallas, because that's what everyone did 10 years ago, evidently. So things like that. So if you're passive, track record, depth of experience of your sponsorship group, looking at the capital stack, are we fully leveraged? Do we have term left on our debt? Can we refinance this if the plan doesn't go? Do we have proper management in place and depth within the management team? That's certainly something I would look at. And do we have confidence that we have a good plan in place? Are we buying something that is underperforming, that through the efforts we can force some value and increase the revenue? And is there some documented rent comps in the area that support the revenue assumptions? So those are just some things that I think about, Paul.
I think we're going to go through right now a recalibration of yields back to the investor. So back 4 or 5 years ago, people were getting 13, 14% cash on cash yields, and those were the good days. Today's not that day, but we're having a lot more money coming into the marketplace right now, and they can probably recalibrate it down to maybe a 5-6% cash on cash rate of return. That's kind of a normal number. Think about that, normal. The second thing is, and if everybody's heard me, I do not like preferred rates of return back to investors at all, because I don't understand the mathematics that go along with that deal. Because right now, say cap rates are at 5%, but you've committed to your partnership that you're going to pay them 7 or 8 or 9%, and the just numbers don't work. So you're going into a negative every month if you can't do it. Explain to what I mean.
Yeah, so I think one of the risks, there's some pros and cons to it. The benefit from a passive investor standpoint, if you're going to get, say, called an 8% preferred return, is the way it works is the passive investors get 8% of their money first before the sponsor gets into their split, their waterfall, or their promote, whatever you want to call it, which is great. And the sponsor, then if the sponsorship can't pay it out, they can only pay out 6%. The 2% is accrued and carries forward, and then they get their 8% every year plus any accrual before the sponsor makes any money, which sounds great, and it is great from that standpoint. But the risk of it really is from the counterparty risk of it is the sponsor. If the sponsors, got 2% behind, and then next year they got to pay you the 8 plus the 2, so you're 10%. Then you hit a recession, they can't pay that. Then in the next year they got the 10 plus the 8, so they're 18, and it's like the sponsors kind of digging themselves a hole. They look up out of the hole like, hey, how can I ever get out of this? I'm never going to make money in this deal as a sponsor, so let me give the keys back. Let me sell this deal, and it kind of gets in a position where you potentially can disalign interest from the management team to the equity investors in the deal. So not saying it's always bad or there's anything like that. And then the flip side is true if you have a big waterfall split where once you get past the pref, and then the sponsorship group can get upwards of, say, 50% of any sort of upside in the deal. So then the sponsors get these outsized returns. It just doesn't make the interests align perfectly as if they didn't have the preferred rate of return. So it just has a potential to disalign interests and then make the management team or the sponsorship group make decisions they wouldn't otherwise do if it may or may not be the right thing for the situation for the property if they didn't have that artificial economic incentive in the deal.
If rental income was growing at 7 or 8% annually every year, like it was back 3-4 years ago, it's not doing that today. It's at 1.5-2% or so. So NOI is not going up. So that's probably the biggest thing I'm concerned about on these transactions is these holes in the backyard that people are going to get buried in, so to speak, because they've promised these rates of return to their investors and they're not going to be able to deliver it because you're not going to have that NOI continue to grow.
So, I mean, a lot of you guys might be sitting here in the audience and going, well, based on everything I've heard, it just kind of seems like, did I miss the opportunity window? Maybe you guys can talk a little bit about, hey, I just got started in the business. Did I miss the window? What am I doing?
No, man, I think there's always an opportunity. Today you got to work a little harder for them. So some of the things that I focus on is just, finding stuff that is underperforming relative to nearby similar properties that are, similar vintage, similar quality, similar size, similar location, and coming in that have, a very obvious, simple business plan of, taking my property that looks like crap and making it look like the nice one down the street and I can raise the rents. I mean, that's really simple, and that's really what I do for a living. It's just really simple. No one's going to accuse me of being the smartest person here besides Paul. So, it's really simple. It's really straightforward.
But you did go to college for 8 years.
Yeah, I
you?
did. Yeah, I'm not a doctor, so. But in all seriousness, this business, the more simple you can make it, the better the deal. The more complicated the deal, the worse it's going to be in most cases. And real estate's a really dumb business. You just got to follow the fundamentals of it, and that's what makes it so powerful and impactful. It's really straightforward. So if you can find that opportunity, you find something that's in a good location, that's it. One of the things specifically that we're doing right now that we've done for the last couple of years, which I think is going to pay off, is Paul referenced on these deals that have long-term fixed rate loans on them. They have these very large prepayment penalties. They're either called yield maintenance or defeasance. But basically what it is a very large prepayment penalty. It's a formula that kind of burns down as you get closer to the maturity of the loan. And if your interest rates go up, it also can burn down the prepayment penalty. So what's happening, if you can come in and buy a property and take over and assume an existing mortgage, you tend to get a little price break on the purchase price because the seller doesn't have to eat that prepayment penalty. So that's one of the things we've been doing. We've been coming in, assuming a mortgage, putting a little bit more equity down, and getting a cost basis break. So that's one of the things that we're doing. So if I was new, I don't think you necessarily missed it. You just need to make sure you're in the right location. I don't know what's going to stop the Texas story. It's growing. We have population growth. We have job growth, and it's all relative. So if you're in a location like we presently sit, it's probably a lot more challenging to make something make sense down the street than it is in Dallas or Houston or Phoenix or Atlanta or one of these other markets that have job growth, population growth. And with a tax reform, everyone in this room that earns an income here lost, and everyone lives in Texas won because of the SALT deduction. So I think that might likely exacerbate what always has been the migration for the people, the regular working people that don't make a ton of money, to get out of the high income tax and go work in a state like Texas or one of the Florida or someplace like that.
So I don't know when the end of the world comes on the multifamily side. I really don't. I've done this for 30 plus years, and I've gone through a number of cycles. There's never a knock at the door saying we're going to be back here in 6 months and we're going to kill everybody. That's just not. It just happens the day before in the capital markets. It turns it off just like that. But I will tell you, in multifamily is that everybody needs a place to live. Somebody needs a place to sleep. Somebody needs a place to go, to come back to. On retail, I see Amazon being that retail killer, continues to be that way. I see people that have migrated out of office jobs into either working out of their house or doing like Regis locations. So I really see multifamily still being the bright light to put money into. And in Texas, we're not building enough apartments. We still have so many people coming to Texas throughout the world. I think I had read just in the Dallas-Fort Worth area that we have 375 or 400 people a day coming to Dallas. So that's not gonna change anytime soon.
And I'll ask you, JC, you own a property you purchased in 2007, and so you what was your experience? I mean, I'm sure your value went down, but what was your experience?
Yeah, I think Michael said it perfectly, right? I mean, if I look back at our experience when the downturn happened, and I had just bought 3 properties, 105 doors in 2007-8, the market crashed, and like Michael said, the financing spigot turned off. But I was always a long-term guy. So I always figured I was going to keep deal for 10, 15, 20 years, maybe for good. So if you look at what happened, and I did look at the analysis of what happened, we were always cash flow positive, even in the pits of the recession, because we always focused on buying deals in good locations first and foremost, right? So the people that got hurt were the people in the sort of the hood, right? But the second thing was that if you're focused on cash flow primarily first, and you put equity as a second priority, which is important, but if you look, we picked up those 105 doors in Garland for $26,500 a unit back in 2007, which I thought was an incredibly large amount of money to pay for those deals, but they made sense from a financial perspective. If we had some sort of a window of lending that forced us into some sort of a refi or a sale because of the balloon payment during the recession, those deals were only worth $20,000 to $25,000 per unit. So technically, we were underwater in the depth of the recession, but we were still cash flow positive. So the lesson is that because we were long-term focused and we made sure that our debt window was nice and long pathway, we came right through the other side. And those deals were worth a whole heck of a lot more than $26,500 per unit, not more than 5 years later. So I think that's the key, is if you put your long-term head on in this sort of business, you ride through those downturns. It's like hibernating for a bear. You got to make sure that you ate enough during the good times, and you go to sleep for a little bit, and you pop up, and you're okay. So, I think the last question that I want to end this with is, hey, look, I saw about half of the room is passive investors, right? So if these folks in here are passive investors in the room, what should they be looking out for in this market today?
I think first and foremost, there's always a deal out there, and there's a lot of good deals out there, but you make sure you're with high quality people, experienced sponsors, people with integrity, people with some transparency. Those are things that matter. I think that if you don't have it, you'll definitely miss it. That's for sure. So one of the things we strive to do in my company is report, on a monthly basis. We give a very transparent report. We give copies of the income statement, balance sheet, general ledger, copy of the bank statement, and then give like a little narrative. So I don't want to surprise people. I try to do that on a consistent, regular basis, give transparency. There's good times, there's bad times. You need to kind of let everyone know that it's not a perfect business. When you go in these deals, you make projections, and like one of the things I'd say is every projection I've ever made has been wrong. So I've either done better or I've done worse. I've never exactly done what I said I was going to project to do. So we either do better or worse. So make sure you have a good quality sponsorship group that you have a good comfort level with. That's first and foremost. And then the deal's kind of secondary. The deal's important, the location's important, the story of the deal's important. And then anyone that can't simply explain whatever the transaction to you in 60 seconds or less, I would probably pass on it. This business is super simple, or should be, and if it's a really complex answer, then I would run. So that's, I guess, kind of the real high level, Paul.
That's about it. I agree with everything Michael said.
Yeah. So, Michael, if somebody wanted to reach out to you before we end podcast recorded version, and we'll open it up for Q&A. How would they?
Yeah. So the easiest way to find information about myself. So come say hi to me after this. But my company's SPI Advisory. So it's SPI like spy advisory.com. Just go to the website, and I'm always happy to have a quick 10 or 15 minute telephone call with people that listen to podcasts or meet here. We can always set that up and do that at some future date. So there's a contact us form on our website. Just fill that out, and we'll get a call set up.
So I'd like to thank J.C. Castillo for setting this up, the Apartment Investor Network in San Jose, California. Hopefully next time we'll have you, if you're listening to the podcast, join us up here in San Jose. We'll let you know next time the meeting will be. So J.C. Castillo, thanks for joining us. Thanks to our audience. Michael Becker, smartest guy in the room, thanks for joining us. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.